KEI's 55% retail surge, revolution or risk? Welcome to Q4 FY26 earnings teardown of KEI, your portfolio's next smart move. Our teardown roadmap covers 4 critical areas. First, we'll analyze top-line drivers and the B2C retail catalyst. Second, segment profitability and margin expansion. Third, the health of the balance sheet. And finally, the risks and our final investment synthesis. At a glance, the numbers are impressive. Revenue hit 3,477 crore, up over 19% year-on-year. Profit after tax followed suit, jumping 25.5% to reach 284 crore. We also see EBITDA margins expanding by 60 basis points to 12.21%, supported by a pending order book of 3,585 crore.
The real story here is de-risking through retail. KEI is strategically moderating its dependency on low-margin institutional EPC projects. Instead, the dealer and distribution network has exploded by over 29% and now accounts for 55.7% of total sales, turning KEI into a retail compounding machine. Breaking down the Q4 income statement, the 3,477 crore revenue was driven by retail and extra high voltage segments. EBITDA rose 25.4% to 424 crore thanks to strong volumes, and EPS stands at 29.74 with a stable share count following their QIP. The margin trajectory is firmly upward. EBITDA reached 12.21%, while PAT margins hit 8.18%. This expansion is fueled by a higher B2C retail mix, normalized tax rates, and a surge in domestic extra high voltage sales, which grew 63% to 188 crore.
Where is the money made? Cables and wires remain the core engine, generating 3,297 crore with a 12.45% margin. Stainless steel remains a high-margin niche, while EPC projects are being intentionally kept flat to focus capital on the higher-margin core business. KEI has built a balance sheet fortress. They hold 1,513 crore in total cash and bank balances, including unutilized QIP funds. With only 186 crore in total debt, the company maintains a net cash surplus of 1,327 crore, meaning their debt is almost entirely for working capital. Looking at the cash funnel, the quality of earnings is high. From an FY26 PAT of 918 crore, they generated 840 crore in cash flow from operations, a 91.5% cash conversion ratio. This allowed them to deploy 1,132 crore into capex, while still paying a 225% dividend of 4 rupees and 50 paise per share.
Operationally, the B2C expansion is driven by a massive network of 2,125 active working dealers. However, there is heavy regional concentration, with the North and West zones accounting for roughly 65% of total sales, which is something to keep an eye on. Time for a red flag watch. While revenue grew 20.6%, inventory spiked 38.7% to reach 2,400 crore. This could mean they are front-loading for capacity expansion, or it could signal a slowdown in channel movement. It definitely requires monitoring. The bull case for multiple expansion rests on 3 pillars: retail de-risking as B2C crosses 55% of the mix, EHV leadership as a high-tech infrastructure proxy, and a 1,513 crore cash war chest that allows for aggressive expansion without taking on leverage.
On the flip side, monitor these headwinds. Raw material volatility in copper and aluminum could squeeze margins if price pass-throughs lag. The 2,400 crore inventory pile could stretch working capital, and geo-concentration in just 2 regions creates localized economic risk. The final verdict? KEI is successfully shedding its cyclical, low-margin identity. Driven by dealer expansion and EHV dominance, it is transforming into a high-margin, cash-rich compounder. While inventory levels need watching, the structural thesis remains highly constructive. What's your take on KEI's retail pivot? Drop your thoughts in the comments. And if you found this KEI Industries earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.